mode.
Hi there, and thank you very much for joining me on the week ahead for the week January the 29th. It'll be starting. Today's date is January the 26th with me, Fiona Cincotta, Senior Market Analyst at City Index. So if we could just start by having a quick read through the risk warning. Sorry if you've just done this, but it appears that my sound wasn't working on the computer. So I do have that fixed now. So if you have seen these slides before, then just give it another quick read. Also, I'll just mention, if you do have any questions at any point, then please do pop them into the question box. So moving on, what we'll do is we'll start by just having a look at the economic calendar on the website here, and then we just filter it by what's showing as high importance. Here we've got on Tuesday, kicking off with GDP data from Germany and from the Eurozone. So, we know that Germany, I'm just going to talk about here particularly, we know it's been extremely weak. We're expecting to see a prolonged contraction in the economy. Expectations are for a 0.4 expectations are still, I think they are for around 0.4% contraction, but that's after a 0.1 contraction in the third quarter, which was actually in the end upwardly revised. So if we just have a look here, there was an upward revision from that 0.1 to just about into the top line, which means that we could be seeing further weakness in the German economy. Now, if we remember, sort of German economy in 2023, so the whole year is expected to have contracted by around 0.3%. The Bundesbank have said that at best they expect the economy to stagnate in Q1 of 2024. And I mean, if we just think about what data we've seen recently from Germany, we've seen the IFO business sentiment, we've seen consumer confidence came out today, and these have been very weak. They've both come in well below expectations. PMI data, which we saw at the beginning of the week, however, whilst still deep in contraction, does suggest that perhaps that the downturn in the German economy could be bottoming out. But yeah, I mean, as far as expectations for German growth are weak and low as we speak, and that's basically because they've been really hit by the manufacturing slowdown that's been across the globe. But Germany is considered the factory of the Eurozone, and that's really not what's been driving it recently. And even then, the consumer confidence is so weak that we're not really seeing any support there. Retail sales have also been extremely low. So just having a look to see what that means as far as the charts are concerned. Here we go, having a look here at the DAX. Now, looking at the DAX, you wouldn't necessarily think that the German economy is in a whole world of trouble as it powers towards all-time highs again, but actually what we're seeing here is the optimism that the ECB could soon start cutting interest rates, and also that the Federal Reserve could also start cutting interest rates, and also thanks to some stimulus support in China. So we can see, the DAX has taken out this level here of the 6,800 and is heading up towards that 1,700 all-time high. If we get a break above the 1,700 all-time high, then we're going to be looking towards that 17,500 as a next target. As far as support's concerned, immediate support is at that 16,800 level. If we get a break below there, then I think here, we've got that 20 SMA around the 16,680. Which could, a fall below there would sort of just negate that near-term uptrend that we've seen. But look, we can see here the 50 SMA seems to have been offering some support there and guiding the price higher. So I'd also watch out for that level around the 16.55.25 on the downside. But for a lower low to be in place, we'd need to break down the 16.350 level. It's interesting here, RSI is showing signs of recovery. So that's just what to be watching for on that one. So getting back to the economic calendar, as I said, we've got Eurozone GDP as well. I'm going to touch on the euro a little bit later because we also have Eurozone inflation data out. Also German inflation data and retail sales figures as well. And look, here we go. Main feature of next week, without a doubt, is going to be the Federal Reserve interest rate decision. Now, the Federal Reserve is expected to leave interest rates on hold at the 5.25 to 5.5% level. That's a 22-year high. The market is not expecting, as I said, any changes on that, and therefore the focus is really going to be on the press conference and what Jerome Powell has to say about potential rate cuts and the timeline of the first rate cut. That's going to be the key focus. Now, it's been interesting because the expectations have really been reined in recently. The market had been, well, the market is currently not pricing in a rate cut in March as a base case scenario. It's just a little bit in favor of the Fed not doing anything, but it is, I mean, talking about 50-50. But this is down significantly because if we think about where we were just at the end of December, the market was pricing in around an 85% probability that the Fed were going to cut rates in March. So, you know, we've seen a real reassessment of those expectations, and that's basically been on the back of a series of stronger than expected data for the US, as well as hawkish commentary from Federal Reserve officials. So as we've seen that expectations, as we've seen those expectations rein in for, or should I say pushed back, then that's obviously offered support to the US dollar. And it also resulted in a wobbly start for equities at the start of the year, although they've pushed on higher to those record highs more recently on the back of some upbeat earnings and AI optimism. But I think what we're going to be watching out for, the market's going to be super keen to be seeing what the Fed has to say about the timeline of rate cuts, if it does even suggest any timeline. Because the other thing to bear in mind here is, you know, inflation's just ticked higher. We saw inflation rise to 3.8%. We had data in yesterday for the GDP, US GDP, which came in significantly stronger than expected at 3.3%, ahead of the 2% that was being forecast. So, you know, between strong growth and sort of still inflation, which is still considerably above the Federal Reserve's 2% target, there isn't really, like, you know, the data isn't giving the Fed real reasons to be looking to cut interest rates sooner rather than later. Just having a look here, this is the US dollar, Japanese yen. Now, as I said, you know, as we talked about here, that reassessing of the Federal Reserve rate cut expectations, as the market pushed back on rate cut expectations, we saw the US dollar, Japanese yen power higher from that low of around 140.25. Now the price taken out the 200 SMA, it ran into resistance around here, which was the 148.80 level. That was last week's high, and the price has actually just been consolidating between this low level here, the 146.60, which was the weekly low, and that weekly high, sorry, last week high of 148.80. Is pretty much sitting bang on the 100 SMA at 147.50. What we've seen is the yen has had a little bit of support this week after the Bank of Japan hinted that it could adopt a more hawkish monetary policy stance sooner than the market was expecting. And as I said, that had offered some support to the yen across this week, which is why we haven't necessarily seen that US dollar yen power higher. As far as levels to watching, you know, buyers are going to be looking, if we get sort of a more hawkish stance from the Federal Reserve, buyers are going to be looking for a rise over that 148.80 to get that 150 psychological level in order to create a higher high. Would be moving up that way. Sellers, if we do get a dovish sounding Federal Reserve, then sellers will be looking to take out the 146.60 to open the door to this level here, which is the 145 round number. And also we've seen there that was the July high. Okay, so moving on, what else are we watching out for next week? There is, as I said, pointed out here, there is Chinese data, which is going to be interesting to keep an eye on. Particularly as far as the resource stocks are concerned on the FTSE, and also as far as oil prices are concerned. So if we just have a look here, the manufacturing PMI is expected to come in a little bit softer in January than where it was in December. Now, concerns over growth in China have been well documented and you know, are quite clear. The economic recovery there has been much more fragile than what everyone was hoping for. We did see that Chinese authorities have stepped up this week with some stimulus, and that has offered some optimism into the markets. We've seen it'll be a good opportunity, I think, just to take a look at oil prices. Obviously oil, China is the world's second largest importer of oil. So if we get strong manufacturing data, if we get signs of an upbeat recovery and more sort of support measures from Chinese authorities, that can be considered bullish for oil. If we have a look here, oil has rallied up really quite nicely over the past couple of weeks. Also supported this week by the stronger than expected US GDP data. This is the key level. We are right up there at that 200 SMA at 77.60. You know, if we get stronger than expected data from China, then maybe we could see a move above that level, and that will bring in this level here, which is the 79.60, pretty much the 80 static resistance. Then you've also got the dynamic 100 SMA as well, so that's sort of around that 80, the psychological level as well. Around that level there's quite a lot of resistance that it'll need to overcome, but first of all the 200 SMA is going to be key. If we can get a close above that, that will be really important. On the downside, 75.50, that's the last week's high, and then below that then we'll be looking at the 72.70 level as an area of support. So what else? Here we go. There's the inflation that I was talking about for the Eurozone. So if we just remember, right, cast our minds back to December, inflation ticked higher to 2.9%. It's expected to remain steady at 2.9%. Interestingly, core inflation is expected to cool slightly to 3.2% from 3.4%. Now, we had the ECB meeting this week. The ECB still expect inflation within the region to continue cooling, although interesting, it doesn't really expect it to get to that 2% level till well into 2025. And you can see where we are now. Obviously, we've fallen quite considerably from double digits. It's expected to continue falling, but at a slower pace. Now, it was really interesting because we had the ECB interest rate decision yesterday, where the central bank left rates on hold at the record 4%. And there was no offer of any hint for the timeline as to when the central bank could start to cut interest rates. In Davos, ECB President Christine Lagarde suggested that it might be in the summer. The market thinks that the ECB is going to cut before that. The market's pricing in a 76% probability that the ECB will start to cut rates as soon as April, and is also pricing in around 142 basis points worth of cuts across 2024. So that's some pretty serious cutting that's expected or being priced in at the market. So let's just have a look what that looks like for the euro US dollar. Here we go, we can see. So euro US dollar, again, look, 200 SMA. 200 SMA is coming up as a pretty key level on a lot of charts at the moment. There's a really good article as well online regarding the SMA, the 200 SMA. So do have a look out for that on our website. But as we can see, you know, we've been talking about the ECB has pushed back on rate cut bets. The market doesn't really believe them, and that's because of the weakness that we've seen in growth in the Eurozone economy and the fact that, you know, inflation, yeah, it ticked higher to 2.9%, but it's still, you know, pretty close to that 2% level of all the sort of major central banks. They seem to be more on track towards that 2% level than others. Meanwhile, at the same time, we've got that US dollar where, you know, which has found recent strength as the market has actually pushed back on interest rate cut expectations, offering some strength to the US dollar. What we're going to be looking for here is key that we get a close below that 108.45 level, 108.50. We can see here we've got those slightly longer lower wicks, which suggests that selling demand at that lower, at those lower levels wasn't strong. So, you know, it's definitely having a struggle to get a close below that 200 SMA. If we did get a close below that and the price could take out the 108.20, which is the weekly low, then that could really open the door to this 107.50 level. As far as any recovery is going to be going, I mean, we need to, and should the 200 SMA hold, then we'll be looking for a rise above the weekly high, which is 109.30, to bring 110 into focus. Moving on quickly, I feel like I'm rushing through it a little bit, but the time always does go so quickly. We've got the Bank of England interest rate decision. The central bank is expected to leave interest rates on hold at, interest rates on hold at 5.25%, a 15-year high. If we have a look and think about where we are as far as the UK economy is concerned, I mean, it has been pretty weak, but PMI data that we've seen, particularly the service sector, which is the dominant sector in the UK, is growing at a stronger pace than expected. So that also means that service sector inflation, which is proving to be sticky and is very much under the Bank of England spotlight, could continue to remain sticky, which is why the Bank of England potentially has been sort of adopting this slightly more hawkish attitude towards, or stance towards, monetary policy compared to its major peers, such as the Fed or the Bank of England. I wonder whether that will start to change this meeting. Will this meeting be the meeting where obviously we don't get any movement as far as rate cuts are concerned, but maybe the Bank of England will drop its hawkish guidance, though. That's when they're saying that they could continue to raise interest rates. Maybe we're going to see them remove that in line with what we've seen from the Fed and the ECB. Still, I mean, the pound's been really well supported, and that's basically because the market is pretty certain that the Fed and the ECB are going to be cutting interest rates before the Bank of England does. Let's not forget, inflation in the UK is still 4%, so it's still double the Bank of England's target level. What's been going on here with sterling, pound US dollar? Look, we've seen it trades, you know, pretty within this sort of horizontal pattern. It has been sort of hovering around this 127 level now, just across the past, past couple of, almost since the start of the year, to be honest. And yeah, as I said, that's support on expectations of a more hawkish Bank of England compared to the Federal Reserve. Obviously, what's going to keep the cap on gains in sterling here is concerns over the outlook for the economy, which is expected to deteriorate. As far as levels to watch are concerned, buyers are going to be looking to get over that 128 level. That's going to create a higher high. If we can get over 128.30, then we'll be up at strong levels. As far as the downside is concerned, like again, you've got the 50 SMA, which just seems to be offering some minor support there around the 126.60, seems to be guiding the price higher. But sellers will be looking for a break below 126 to create a lower low and expose the 200 SMA. Just finally, oh yes, we've also got, how could we forget, with so many central banks going on inflation data, but of course there is also the US non-farm payroll report, which is due on Friday. So Friday we're expected to see still maybe a little bit of weakening in the US non-farm payroll report. I mean, we have seen that the report has remained strong. I mean, you know, we had 216,000 jobs added last month. That was well ahead of 175,000 that was estimated. Unemployment held steady at 3.7%. Average wages saw relatively strong growth. So, you know, there's still a very resilient US jobs market, which is really helping to fuel that soft landing narrative and keeping well, you know, whilst we've got the soft landing narrative and strong jobs market and solid growth, the Fed doesn't really need to start cutting interest rates right now, right? So that's sort of what we come back to time and time again. Let's just have a look at what this means as far as the Dow Jones is concerned. Dow Jones, as with its peers, hit fresh all-time highs this week, rising over 38,000. Have seen sort of, you know, a little bit of consolidation, I would say, after that break above the resistance level there. As far as levels to be, if we can get above the 38,100, that's going to bring sort of 38,500 into focus. Just worth having a look here though. Look, we got sort of the bearish divergence on the RSI, which isn't generally an upbeat sign. So, you know, just be wary about that. As far as support is concerned, 37,800, if we get a breakdown there, that's going to bring this level in here, the 37,000 level into focus. And just finally, the other thing that we've got going on next week, obviously, is US earnings season, which is really ramping up. We've had some mixed performance so far. We've had, you know, most chip makers, some chip makers have performed very well. Those are closely tied to AI. Intel, for example, though, another chip maker, very late to the race as far as AI is concerned, has plunged around 12% today in the pre-market trading because of disappointing guidance. Netflix smashed it. Tesla disappointed. This week we've got Apple, Amazon, Microsoft, Meta trading. So, oh, and Alphabet. Did I mention Alphabet? All of those have got their trading updates on the 31st of January and the 1st of February. So there's going to be a lot of focus on those because they are, I mean, you know, we've got some really lofty valuations. If we think about where Microsoft has risen to a market cap of 3 trillion. So, you know, we've seen a really big run up in a lot of these stocks, and the market is going to want to see that the lofty valuations are actually supported by strong fundamentals. Outlook obviously is going to be very much in focus as well, but then we've also got the consumer element here, which is very much in focus, for example, at Apple and on e-commerce giant Netflix, Amazon. So let's just have a quick look whilst we're here at US, the Nasdaq. Nasdaq has powered higher to record highs, 17,668 earlier this week. We are in overbought territory as far as the RSI is concerned. Also, just look here, we've got those long upper wicks on the candle, which is a little bit of an ominous sign suggesting that demand at the higher level wasn't really there. You know, if we do manage to get to take out that level, the 16,660, it should be 16,666, right? If we do get to take out that level, then 18,000 is going to be a key level to watch. On the downside, watch for support here just below the 17,000 level, which was the late December high. So that is all from me. If you do have any questions, then please do pop them up. Otherwise, I will see you, Otherwise, I will, this video can also be found on our YouTube channel, and do reach out to me on my Twitter at Fiona City Index. Thanks very much for joining me, and have a great weekend.